On today's hot sheet, I'm discussing the markets where investors are buying and where they are pulling back. Plus, new data on builders' confidence, housing starts, and unemployment claims. Today is Thursday, January 18th, 2024. I am Byron Lazine, and the hot sheet starts now. Good morning. Let me know in the live comments which market you are tuning in from. I'm here in my Naples, Florida studio. And to get the most out of everything we do here at BAM, join BAMX. Use code HOT to get 10% off of your BAMX membership, which would include show notes every single day from the show, as well as our slide downloads, all of our courses, live streams, and our community. Join BAMX by using code HOT to get 10% off of that. Let's talk investors. We've talked a bunch in the last couple of weeks about how it's not as big of a deal, especially institutional investors, as headlines make it out to believe. Every month, it feels like the headlines on investors and real estate comes out, and Twitter X just explodes with people saying investors are buying all the homes. This is why there's no inventory. But we know institutional investors own less than 1% of the housing inventory, but it's still smart to see which markets they're investing in, which markets they are pulling back from. Might be some information you want to share with your investors or some strategies that you want to follow. Investors currently, according to Parcel Labs, as covered by Resi Club and Lance Lambert, are pulling back from markets like LA while diving into places like Milwaukee. They're notably stepping back from high-cost markets, says Parcel Labs, and we'll take a look at the data here directly. Milwaukee here, a 1.0, as you see on the table, okay? 1.0 would represent for every investor home purchase, there was one investor sale. So a one-to-one harmony. Anything above one would indicate investors are purchasing more units than selling, and under one would be the inverse. This is Jason Lewis, who's the co-founder of Parcel Labs. Okay, so in Milwaukee, you've got a 2.0. All right, so 2.0 here for investors in Milwaukee. You've got Denver, Atlanta, St. Louis, San Antonio, Indianapolis, which has been a hot spot for investors for some time now. Philadelphia, Houston, Columbus, Ohio, another one that's been very hot, very robust market. And you've got Baltimore, Virginia, Dallas, Charlotte, Cleveland, Kansas City, Cincinnati, New York, Minneapolis, Nashville, Pittsburgh, Detroit, and Austin, all up over one, Austin being at 1.1. The only two markets that are in the 2.0 range would be Milwaukee and Denver back at the top. Now, if we go to the bottom, you have San Francisco at 0.2, San Jose at 0.3, LA at 0.4, San Diego at 0.4, Sacramento at 0.4, Riverside at 0.5. So you're just seeing California just fill in the bottom of this list. Then you get to Boston at 0.7, Portland at 0.7, Seattle at 0.8, Las Vegas at 0.8, Phoenix at 0.9, Providence at 0.9, Chicago 0.9, Tampa 0.9, Orlando 0.9, Washington, D.C., Jacksonville, Miami, all in that 1 to 1.0 harmony range. Okay, so why are these markets specifically, the six or seven there in California, and then a bunch in the West Coast, Portland, Seattle, Las Vegas, Phoenix? Why are those markets all have investors pulling out of them? It's cash flow. They're very pricey markets. It's very expensive to purchase real estate in those markets because of the appreciation that has gone on there for many years. And really, you're just pricing yourself out of a cash flow situation, a return on your investment for investors. I think you're going to see this trend in other markets as well. Nobody has a crystal ball, but if I were to guess, I'd look at Florida, some of the markets in Florida. What was Miami? Miami was in the 1.0 range. I could see Miami going down closer to where some of those California locations were on this table. Miami's gotten very expensive, but it's not just that. It's that these areas in Florida have skyrocketing insurance costs. Remember, Lance Lambert covered the skyrocketing insurance costs in places not only in Florida, but Texas, along that entire Gulf Coast, along the entire eastern seaboard, it seems. Just last week, I had to make a call up to Connecticut for my Connecticut house, say, hey, is my basement flooded? I'm right next to Main Street, which looks like a river right now. President Biden had to do an emergency declaration for shoreline towns in Connecticut after heavy rains flooded many of the shoreline towns. So there's a lot of issues with insurance as it covers the eastern seaboard of the country. We know that the West is dealing with the same thing. When you think about California, we think about the fires and some of the issues that they have with insurance. But as insurance continues to skyrocket, and then as taxes catch up, I mean, specifically Northeast, right? You could really start to see a scenario where investors are like, there's not an opportunity here for me to really make a return. If I were to buy a new house right now down here in Naples, for example, um, with the with my insurance, which has doubled, my homeowner's insurance, which has doubled the last 12 months, I don't know that I'd keep it. I'm up big on the house. It's my primary residence. I don't pay capital gains on that. So would you keep it for to deal with a tenant and get, you know, after expenses, a few grand a month? I don't know if it's worth it in consideration of all the equity that I've gained. And one thing goes wrong, 2 grand profit turns into zero for the year. You replace AC or something like that. So these are the things that investors are looking at. These are the opportunities that they're considering, and there just happen to not be in some of these major metros. Again, you've got Milwaukee. Denver's a major area. Atlanta's certainly a major area. But Atlanta's going to keep growing, right? I think about Charlotte and Atlanta. Charlotte's on the list here at 1.2. But you see St. Louis, rather, San Antonio, Indianapolis, Philly, Houston, Columbus. Okay, so I think there's gonna be more opportunities to grow in the Midwest, especially when it comes to investor opportunities. But according to Parcel Labs, that's where investors are pulling back. Now let's find out what the builders think about the market. Are they pulling back? Well, last month, their sentiment rose. It surged on falling interest rates. Mortgage rates well under 7% over the past month have led to a sharp increase in builder confidence to begin the new year. Builder confidence in the market for newly built single-family homes has climbed 7 points to 44 in January, according to NAHB, National Association of Home Builders, and the Wells Fargo Housing Market Index, which was released today. It's the second consecutive month for an increase in builder confidence, and it's tracking along with this drop in interest rates. But as you can see here, this is well below. If we're looking at the right of this chart, we're right there at a 44. So bouncing off of a low 2 months ago that was in the low 30s. We've bounced off of that, thankfully, with builder confidence. But you're still below a 50, and you're well below the majority of time when we were going from, say, 2014, even all the way back to 2012. We've really sat above this level at 44 outside of the 1 quarter of COVID. This sharp line here going down would be the COVID line. And then the next sharp line, which is bigger than the COVID line, is when they started increasing the federal interest rate. Had a little pop up last year, got as high as the mid 50s until declining again when you saw those rates get up to 8, and then now back up to a 44 level. You've seen confidence here over the years. Obviously, the lowest level was in 2009 when it got below a 10. Nobody was building. That was middle of a major recession, the great financial crisis. During that period, you never saw confidence go up over 20 for builders. If you go back into, all the way from 85 until that point, you really hung up above 50, except for the um, 1990-91 recession. Even during the '01 dot-com bubble, you still saw builder confidence for the most part sit above 50. So that's where we're at today. Builders are more confident right now this month and last month than they have been the months prior, but still well off of some of the high marks that we were seeing coming in. So builders are going to continue to be cautious, which tells me probably we will see a decline in housing starts if this trend continues to remain under 50. Just released today, the U.S. Census Bureau and U.S. Department of Housing and Urban Development jointly announced the following new residential construction statistics for December. You can see here building permits coming in at 1.495 million, housing starts coming in at 1.46 million, housing completions at 1.574 million, and you can see here new residential construction chart going back to December 2018 for permits, starts, and completions. Permits boomed obviously from 2020 till they started to increase that rate in 2022. Starts did as well. Completions have gradually increased over this period of time. Privately owned housing units authorized by building permits in December is what was 1.9% above the revised November rate. It's 6.1% above the December 2022 rate. Single family authorizations in December were 1.7% above November, and authorizations of units in buildings with 5 or more were at a rate of 449,000. The estimated 1.469 million housing units were authorized by building permits in 2023. This was an 11.7% decline from the 2002 figure of 1.665. So trend here is that from 2022, obviously 2023 building less permit wise. And we'll see obviously if that trend continues here based off of their confidence in the market right now. Privately owned housing, and this comes at a time when we need inventory, right? We know we need inventory. We need to fill in the gap. If we go all the way back to 2023 on housing starts, I'm sorry, 2003. If we go back all the way back to 2003 on total starts, we were up over 2 million between '03 and '06 for the most part. Single family starts, we were at or above 1.5 million for that same time period of 2003 to 2006, before again completely cratering into the great financial crisis, hitting a low on both those numbers at 500,000 or less in 2009, and then took a real slow crawl all the way up until about 2020, when for the first time on starts we hit 1.5 million. But for that entire 10-11 year period, we didn't come close to 1.5 million starts, which is basically where we're at now and where we need to be for an extended period of time to make up that 2.5 to 7 million home inventory crisis gap. If we just look at single family specifically, you've got starts of, again, just about 1 million. We've sat at that level, generally speaking, with a couple of dips in there since 2020. Obviously, just building 1 million homes a year, it's not a 7-year run to get to that 7 million, because you have new households that form every single year, and you also have inventory that is so old it's unlivable. So you've got to replace. You have some replacement inventory, and you have new households coming, which is why they really want to see that number up to 1.5. And I really want to see that number reflect a more median price point, because if all we're doing is building luxury is different in every price, every market depending on price point. If all we're doing is building above median price point, above average price point, then really a lot of these units aren't helpful anyways. And that's a point I've made over the year over and over and over again. A point that the economy continues to make to Jerome Powell and to the Fed over and over and over again is that this job market is strong. This economy is robust, and it just doesn't care all that much about these inflationary measures we're trying to get down. In the week ending of January 13th, we had seasonally adjusted initial claims for unemployment at 187,000. That's a decrease of 16,000 from the previous week's revised level. It's the lowest level for initial claims since September 4th, 2022, when it was 182,000. Listen, here's the chart. We're going down, not up on unemployment, or flat if you look at seasonally adjusted insured unemployment. There's just no movement in the job market. Remember, the Fed's job is to bring inflation down while maintaining as much of a job market as they can. Jerome Powell specifically has said, their last big tool is to break the job market if they have to. They've already patted themselves on the back for breaking the housing market last year, but they will break the job market if they have to, which is why yesterday's sales numbers, retail sales, was concerning because it popped the 10-year. It got investors a little bit worried that potentially these cuts might get pushed back a little bit further out. You have a really strong job market. You have a consumer who's continuing to spend. Even while we've seen inflation come down, we need that trend to continue, maybe even at a stronger level than we've seen the last couple months to get closer to those federal interest rate cuts. Of course, that's what we're rooting for so that we can see this number come back down. The end of the year, we were experiencing a really nice number below 4. Now we're back up above 4 on the 10-year, 4.188. We can take a look here. It won't let me. We'll go over to CNBC, which we see the Dow's down a tick, S&P and NASDAQ are up. But if we go to their chart, it'll let us take a look here. If we just look at the last month where we've gone on the 10-year, we kind of ended the year there at as low as 3.8. Of course, 3-month run, we're doing a lot better than we were when rates hit 8, and we went up over even 5% at one point there in between October and November. So we're doing great on the 6-month run. But if we just look back here on the last month, this is the highest level on the 10-year in the last month. So something to watch out for. Certainly impacted the 30-year fixed. Yesterday, you see this sharp increase, the sharpest increase we've seen in quite some time in a single day on the 30-year fixed, and it jumped up to 6.88. This is the highest since January 9th at 6.8, and again, the highest one-day increase we've seen in quite some time on the 30-year fixed. The highest ground that you can be on on February 7th would be our free virtual event, the BAM Pro Bowl. This is going to be an epic event. I don't know if you've seen the sizzle reel video with the broke agent commentary in the background on Instagram yet. If you haven't, go make sure you're following @NowBAM on Instagram. The BAM Pro Bowl is February 7th. It's a free virtual event for real estate professionals and mortgage professionals. Any real estate professional can join, and it's a Super Bowl of real estate knowledge. We've got an all-star lineup of Ryan Serhant, Neil Dingro, David Childers, Jason Pantana, Gary Gold, Danielle Garofalo, Marie Lee, Jimmy Mackin, and myself. Eric and actually agents will be teaming up together to do a kickoff and an MC. And we actually have a national anthem by Amanda Bradford. This is going to be an event with a halftime show and a post-game show like you've never experienced in real estate. And it's absolutely free. Use the link down below to grab your seat if you have not already. And again, to get the most out of everything we do at BAM, make sure you're in BAMX. You can also find that link down below. That's our hot sheet here for this Thursday. Hope everybody's having a great week. And I will see you guys all back here tomorrow, 9:30 on the East, 6:30 on the West. Until then, toodaloo.